You open your email and there it is, a bland subject line that somehow makes your stomach drop because it's HMRC asking a few questions, or it's the IRS saying they want to verify information, and suddenly every deduction you ever took starts replaying in your head like a crime documentary. The scary part is that most people didn't wake up planning to commit tax fraud because they were just trying to pay less. They heard the word avoidance, and they assumed that if it saved tax, then it must be smart. My name is Hector, and I write scripts that turn tax policy into real-life decisions you can actually make. This matters because the cost of misunderstanding the line is brutal, and I mean brutal in the most practical way, because one side of the line is legal savings you're allowed to plan for, and the other side can be penalties, years of back tax, professional fees, and in the worst cases, a criminal investigation that nukes your career. The trap is that the line is not a single painted stripe, because it's more like a foggy border where planning becomes aggressive, aggressive becomes abusive, and then one bad decision, one missing document, or one too clever scheme flips the whole story from "I did what my advisor suggested" to "you misrepresented your tax position." Stay until the end, because I'm going to give you a simple mental test that catches most danger zone decisions in under a minute. And it works whether you deal with HMRC, the IRS, or any other tax authority that reads your return the way a detective reads an alibi. The cleanest starting point is this. Tax avoidance is arranging your affairs to pay less tax within the law, while tax evasion is breaking the law to pay less tax, and the difference usually comes down to honesty and reality. If you reduce tax because you genuinely contributed to a pension, genuinely donated to charity, genuinely claimed a relief that exists, and you can prove it with records, then you're in the world of legitimate planning, even if the result is that you pay less. The moment you reduce tax by hiding income, inventing expenses, creating fake paperwork, or lying about what happened, you've crossed into evasion, and "I didn't know" stops being a shield once the facts look deliberate. In the US, the IRS even spells out the idea in plain language because avoidance is not criminal when you don't conceal or misrepresent, and you shape events in advance within the rules, which is basically a fancy way of saying you're allowed to plan, but you're not allowed to pretend. In the UK, Parliament and HMRC make a similar distinction in practice, but there's an extra twist that makes the UK feel like quicksand because tax avoidance doesn't even have one neat statutory definition, and that's why the same behavior can be described as tax efficient by a brochure and avoidance by a compliance officer. That uncertainty is exactly why people get hurt, because if you're watching this, you're probably not trying to be a hero. You're trying to keep more of your own money. And the reason this becomes dangerous is that the market is full of offers that sound like planning but behave like a trap. If you want to avoid that, subscribe, because this series is literally about the places audits start and the small decisions that stop an ordinary return from turning into a 2-year nightmare. Now let's talk about the messy middle, which is where the real line lives. Because the line isn't just legal versus illegal. It's also intended versus abusive. And governments built tools specifically to attack plans that technically follow the wording while clearly violating the spirit. In the UK, the big tool is the GAAR, the General Anti-Abuse Rule. And the whole point of it is that even if you can point to a sentence in legislation and say, "Look, I fit inside the words," HMRC can still counteract the tax advantage if the arrangement is considered abusive. That's not HMRC being emotional, because the GAAR is designed to target arrangements that a reasonable person would say are not a reasonable course of action, which is basically the law admitting that pure technical cleverness is not a force field. You can feel the vibe here, because normal planning tends to have a commercial reason that makes sense on its own, while abusive planning often looks like it was built backwards from the tax result. In the US, you see the same philosophy through doctrines like economic substance and substance over form, because courts and the IRS can look past the labels you used and ask whether the deal did anything real besides generate a tax benefit. When you hear phrases like, "It has no business purpose," or "It's a sham transaction," that's the system saying, "We don't care how pretty the paperwork looks if the reality is empty." So here's the first big line test you can use in real life, and it works almost everywhere. If the tax benefit disappears the moment you remove the paperwork trick, then you're probably not doing planning, you're doing theater. Real planning is boring and repeatable, because it's based on incentives lawmakers openly created, like retirement accounts, ISA wrappers, business investment reliefs, capital allowances, genuine R&D credits, and the usual menu of deductions tied to actual costs. The dangerous stuff is usually dramatic, because it needs drama to distract you from the fact that the underlying activity is thin. Which brings us to the audit traps that turn avoidance into evasion faster than people expect, because most people imagine evasion as suitcases of cash and secret Swiss accounts, while the real world is much more mundane and therefore much more common. One trap is concealment, that you convince yourself is harmless, like taking cash-in-hand income and telling yourself it's too small to matter, or running side income through a personal account and assuming it won't be noticed, or forgetting a chunk of freelance work because the client didn't issue the form you expected. Tax authorities love these cases because they're easy to explain to a judge, and they're easy to prove if there's a trail of payments, messages, platform records, or lifestyle spending that doesn't match declared income. Another trap is invented expenses, and this is the one that hits normal people, because you start with something real, like you worked from home, or you used your car, and then you slide into numbers that you cannot support. If you cannot show how you calculated it, why it's business related, and that it was actually incurred, then you're not being tax efficient. You're creating a story that collapses the moment someone asks for receipts. The same goes for personal expenses shoved into a company, because a holiday labeled business development is funny until an auditor asks why the itinerary looks like a brochure and the meeting notes look like fiction. A third trap is misclassification, which sounds technical, but shows up everywhere, because you can cross the line by calling someone a contractor when they function like an employee, or by calling income a loan when it is clearly payment, or by calling a distribution capital when it is basically salary in costume. These aren't always criminal by default, but they become criminal looking when the pattern shows intent, because intent is the difference between we made a mistake and we built a system to mislead. Now let's talk about the trap that ruins people who thought they were being clever, which is marketed schemes, because tax authorities built entire regimes to spot them early. In the UK, there's DOTIS, the disclosure rules for certain avoidance schemes, and the point is that if a scheme has certain hallmarks and it's designed to create a tax advantage in a contrived way, promoters and sometimes users have to disclose it to HMRC. That should tell you something important about how the system sees these schemes, because if a plan needs to be disclosed like a hazardous chemical, it's not a normal tax strategy. And even when a scheme is disclosed, it doesn't mean it's approved. It just means HMRC has your name attached to it sooner. This is where the line becomes very personal, because you might never intend to evade tax. But if you join a scheme that depends on fake self-employment, circular payments, or wages disguised as loans, you can end up in a situation where HMRC or the IRS argues the whole structure was a misrepresentation. A lot of people in these schemes say, "I used an advisor," but the authority hears, "You outsourced your conscience," and the bill still lands on you. If you've got value so far, tap like, because it tells the algorithm you want practical risk maps instead of vague motivation content, and it helps more people avoid the exact traps that always show up in audits. Now here's the 1-minute test I promised, and it's the closest thing to a bright line you're going to get without hiring a tax barrister. Ask yourself first whether what you're doing would still make sense if there were no tax benefit, because if the answer is absolutely not, then you should slow down and get a second opinion. Ask yourself second whether you would be comfortable explaining the plan in one paragraph to a skeptical auditor without using buzzwords, because if you need a 20-slide deck to justify a $3,000 tax saving, the saving is not the point, and the story is the point. Ask yourself third, whether you can prove every key fact with plain evidence, like invoices, contracts, bank records, mileage logs, calendars, and board minutes that were created at the time, because when evidence is missing, tax authorities assume the story was created later. If those 3 questions feel uncomfortable, you don't necessarily have a crime, but you do have risk, and risk is expensive even when you win, because the professional fees, the time drain, and the stress bill are real. On the other hand, if those questions feel easy, you're usually in the zone of legitimate planning, and the remaining work is just hygiene, which means clean bookkeeping, consistent documentation, and not mixing personal and business finances like they're the same wallet. There's one more reason to treat this seriously right now, and it's that enforcement incentives keep getting stronger, because tax authorities have learned that tips and data are powerful. The UK has even moved toward US-style whistleblower rewards for serious cases, which changes the social landscape because it means disgruntled insiders, competitors, and sometimes even partners have a direct incentive to report schemes that feel abusive. Even if you don't love that idea, it means the smartest time to be clean is before you get on someone else's radar. So here's the practical, what should you do tomorrow part? Because this series is called Audit Traps for a reason, and the goal is fewer surprises. If you're doing normal tax planning, you keep it simple and you keep it documented, because simple plans are easier to defend and easier to prove. If you're offered a scheme, you treat guaranteed, HMRC proof, no-brainer, and everyone's doing it as red flags, because real tax professionals do not talk like hype merchants. If the plan involves money leaving and coming back in circles, or it relies on a loan that behaves like income, or it requires you to sign something you don't fully understand, you pause and you get a second opinion from someone who is not being paid to sell the scheme. And if you've already done something that now feels questionable, the move is not to panic and start improvising, because improvisation creates inconsistent stories, and inconsistent stories are what investigators look for. The move is to get your records together, stop repeating the behavior, and speak to a qualified professional about corrections or disclosures, because fixing a problem early is usually cheaper than letting it grow until an authority finds it first.